So 2 years in a row, when you speak to the fuel buyers, some of the biggest in the world, they're angry and they're pissed off, and they believe that uranium is theirs, and that they'll determine it because they've determined it for so many years, and they are literally like deer in the headlights. And the odd thing is because they don't have that financial incentive. They're not going to get fired for what they pay. They'll get fired if they get run out. So you asked me what the catalyst is. I don't know, but here's what I do know.
This is general advice, my opinions, and for entertainment purposes only. CFDs are high risk, past performance isn't reliable. I may be long or short CFDs and stocks mentioned. Content may contain language that offends some viewers. Righto, punters, we've got another global uranium expert, the OG, the man that's been there, let's say from the start, Mr. Mike Alkin, Sachem Cove. Welcome on to LEVRD, mate. Jesus Christ, since 2018, you've been beating the drum about replacement rate contracting and everything. It's nearly up to a decade you're going to be sending this narrative out to the world. When's it going to end, mate? When do you get to retire?
Hey, Matty, thanks for having me. Yeah, I was just saying one of my guys was on a bunch of mine tours in Namibia this past week, and he was talking with a bunch of different investors, and some folks were saying, wow, you guys were really early. You were too early in the investment. And we're like, really? The price of uranium was $18 now. It's depending on if you're looking at floors and ceilings, they're as high as 150, and if you're looking at term pricing, it's almost 90. Not sure what does too early mean, but it does comes with fits and starts. The sentiment moves very, very dramatically sometimes. So at times, days feel like months, and at other times, months feel like days in this investment. But trajectory keeps going up in the direction we want it.
It could have been a trader's dream for that last 8 years, wasn't it? If you just sold on as many highs as you could pick, because when you think it's going to go to the explosion side, pretty much like a week or two ago when spot hit 100, it's like, oh geez, this could be it, and then it happened for one day and then retraced, and now it's following the NASDAQ effectively.
Yeah, and really in the last what's made the investment trickier if you have a really short-term horizon, or you're influenced by what's going on in the blinking lights of the market and everything, which a lot of people are, and I get it, if that's what they're paying attention to. But the correlation with uranium equities, with the AI and data center trade and the SMR trade is, I don't know mathematically what it is, but it's high. And you see the sentiment-wise, how it moves together. Often, if there's fear about artificial intelligence slowing, these stocks can get hit. If there's fear about data, obviously data centers, AI, but then SMRs, they get hit and they'll go the opposite way. When at the end of the day, the reality is the fundamentals of supply and demand for the 430 plus reactors and the 70 plus under construction that are coming onto the grid, there's not enough uranium. But narratives are what they are. So you have to just kind of, adapt to it. You either ignore it and just ride it out, or you just adapt to it and trade around it.
Oh, so I assume the AI build out, SMRs, et cetera, are still not in your models?
No, it's just not necessary. There's a couple of thematics within the theme that we are just not influenced by. One would be the role of AI in data centers and SMRs, small modular reactors, right? Two different things. AI drives more data center growth because it needs more power. Nuclear can be one of those solutions down the road, whether they're small reactors or whether they're the bigger reactors. But that's tomorrow's business, right? Way tomorrow's business. And then there's the small modular reactors, right? There's 70 to 80 different designs for reactors. And just for those who don't know, a big reactor that powers 1 million homes and businesses is a 1 gigawatt reactor. So small modular reactors might go down to from 300 megawatts right? So 3/10 the size of a big reactor down to 50 megawatts, right? So they're smaller. And the thought there is that you can generate scale for the builder because you can build them in a factory and you can send them out, and there could be more, it could cost less to build, and they're smaller footprint. And so even though a big reactor has a small footprint, and those two themes get attached to uranium, right? Because uranium's the feedstock. And Wall Street, investors love a theme. And what winds up happening is, and the bankers love selling themes because that's a lot of fees when they sell those themes and get people convinced that those themes are real. But look, obviously, artificial intelligence and data centers are real. To what extent the growth we'll see play out, who knows? But the point of all this is had that not become a theme, a major theme, had SMRs not become a major theme, when you just look at the nuts and bolts of how many reactors are in the world, how many new reactors are coming online, how many are closing, and then is there enough economically viable uranium to feed those beasts? The answer is no. And then the other part of the equation is there are some new mines coming online. And then you throw it into the hopper and say, with those new mines coming online, is there enough economically viable uranium to feed all of those reactors that I just mentioned, existing, new, net closures and all of those? The answer is no. So that's going to need to stimulate higher prices to drive more exploration and more mines being developed. But the day-to-day movement, because it's such a powerful theme, AI and data centers, these stocks correlate to that very closely. There are some days where it's decoupled, but many days it's not. So, it just depends how one wants to invest around that. You can ignore it and ride it out, or you can trade around it. It just depends what one's desires are.
Because, mate, I want to go through with you everything on the fuel buy side, the utilities, the replacement rate contracting, because as you say there, because unfortunately uranium's such a low part of the nuclear reactor on a cost basis. Like, I know you've said before, like compared to a coal mine where it's all coal, the actual uranium itself is 7% of the cost, or circa that. So it's not the big ticket item,
Exactly. It's high single. It's depending on the price. It could be mid singles, high singles, low teens, but versus coal and natural gas where you're looking 80%, right? So it's enormous.
But so what is there's obviously going to be some tipping point at some point, and like God, if you knew the answer, you'd bloody probably be you wouldn't have to do these YouTube episodes. You'd be well retired now. But what is that tipping point going to be? And I know, like, everyone's been beating the drum for ages, but like, what's going to be the big catalyst to really get fuel buyers stressing to make U3O8 a very big ticket item?
A great question. And I don't know the catalyst. I know the conditions that will lead to a catalyst, and I'm not looking it's always the catalyst you're not suspecting. If you surround yourself with conditions everywhere that are conducive to a catalyst occurring that's going to drive that price higher, then that's it. Or an action. That action is uncovered requirements and contracting. And what I mean by uncovered requirements is, because uranium is the only feedstock for a nuclear power plant, and because the cost of it, the front end of the whole fuel cycle, and that's all the processing. It's U3O8 uranium, yellow cake. It's converted uranium, it's enriched uranium, it's fabricated uranium. That's a quarter of the cost. The uranium that we spoke about earlier is a much smaller percentage of that. But what drives that, and so because of that, because there's only there's no substitute, because it's a 2-year processing cycle roughly. Security of supply is paramount. There's no substitute. You're not a utility running a coal-fired power plant plus a natural gas-fired power plant where you can choose which one you want to run. If, God forbid, you ran out, you could run the other one. That doesn't exist here. There's no substitute, and it's a long lead line. It's a long lead time, couple of years. So historically, if you look back, what's driven the entire purchasing cycle is very long-term contracting. over 80% of contracting has occurred via 3-year, 5-year, 8-year, 10-year, 15-year contracts. That's what drives everything. And so, but if you start looking at the from the early to mid 90s up until today, what you've seen is on a chart. What you've seen is a demand that has or production that has far been much less than the actual demand, but it's lived off of decades of overproduction in the 50s and 60s and 70s and 80s. So you've had inventories being drawn down and drawn down. And then there are various times where you go through little price spikes. In the early 2000s, price went from 7 up to 137 and then all the way down to $17 in November of 2016. So what we look at, the way we try and figure it out from the beginning, and we still do, is, okay, well, if I'm a fuel buyer and I know how much all the contracting that needs to be done based on the number of pounds that are required to feed the beasts. And if you think about the exercise, Maddie, it's not overly complicated. These reactors take 5, 7, 10, 12 years to build, depending on if you're in the East or the West. So you've got a long view into what's under construction. You know how many pounds are required when that reactor is ready to come online. You know the existing reactors. You know years in advance who's going to close a reactor. You just have to sit down and put all the pieces together. And when you look at that, you say, my gosh, there's roughly 3 billion pounds of contracting that needs to occur over the next 15 years. Okay, well, that's a lot. And why do I say 15 years? Because again, if you wanted to build a new mine, just to get from start to finish, it's more than 15 years. So we look out because it's very long lead time items. Well, how long? 3 billion pounds of demand plus for the next 15 years. Well, how much of that is needs to be contracted for? Well, the answer to that is well over 2 billion pounds. And so on just a couple of 100 million pounds a year of demand, roughly growing, mid-ish single digits per year, you're looking at a decade of demand for utilities that's not contracted for. So you say, okay, well, let's go to the next layer. Okay, so now we kind of we could frame that. And then what's the next thing is, okay, well, how many pounds of supply are there? Well, when you look at all of the supply out there and all of the demand that is coming, it's not speculative demand. It's what I just talked about, how the different demand buckets. That's where you're looking at, depending on if you're being conservative or aggressive, 15 to 20 million pounds on the low side to 40 to 50 million pounds on the upside of structural deficits. There's not enough. So as we look at the utilities, one of the big numbers we focus on is replacement rate. You'll hear that thing talked about. And I was talking about that from 2018 and 2019 and 2020. And what that means is, if, let's say at the time, going back to the mid to late teens, you were consuming 160 to 170 million pounds a year in a reactor, in the global reactor fleet, how many pounds were the utilities replacing under long-term contracting? Right? If you're not drawing down inventories, by definition, you'd be replacing what you use. If you are drawing down inventories, you contract less than what you use. Right? Simple concept, basic fourth grade math, addition and subtraction. Well, what you noticed is that in periods where pricing was down, going back decades, utilities would under contract. They would draw down inventories. And so if we look back in the periods of 2000, where pricing was $7 a pound, versus 2007, where it peaked at $137 a pound, for the first many of those years, they were contracting at 35% of what they were using, 35 to 40%. So they were sucking down inventories. And then inventories got low, something spooked them. There were different periods. One of them was a mine in 2006 was supposed to come online in 2007, and that flooded. But along the way, there were a series of little incidents that caused 7 to go to 10 to 12 to 15 to 18 to 25 and so on and so forth. And all the while they're drawing down inventories, but the market speaks. We can proselytize, we can create narratives, but at the end of the day, price is the ultimate arbiter. And the arbiter has spoke. It went from 7 to 137. They were under contracting. Somebody got scared. One of the utilities get nervous. They go in and contract at a price higher than people thought they might have to. And that sets off a race to go contract. And then that's where the laws of supply and demand come in. If you're not testing the market, if you're not discovering price by trying to contract the amount of available supply, then you never really know. And so after Fukushima in March 2011, now the price spiked at 137 a pound in the middle of 2007. By the time Fukushima came around in March of 2011, the price was in the 60s. It just kind of gravitated down. And then from 2011 down to November of 16, it went from the mid 60s down to $17 a pound. And so utilities, when their contracts were expiring as prices were going down, they knew the world was temporarily awash in uranium. Why? Because Japan, where Fukushima melted down, it was 13% of global uranium requirements. There were 54 reactors. Japan generated 30% of their power from nuclear. Those all got shut down. So that uranium had to wind up somewhere. And it wound up going to the utilities, who then put it out. Many of them often put it out the back door to loans and to other people, and it became a supply. So, you're looking at a situation where the utilities were stepping out of the market. If you look back from Fukushima through today, replacement rate contracting has been around mid 40%. So what does that mean? Inventories being sucked down and sucked down and sucked down. And this is where the psychology of investing comes in. This is where anchoring biases and recency biases, meaning what has happened recently will continue to happen. And that's where all the visible, this is why I think the efficient market theory is such BS. It's nonsense. It doesn't exist, because people think that all known information is priced into a stock. You have so many things that are hiding in plain sight when the industry, in visible industries, but when there's an opaque industry like uranium, this price reporting is complicated. It's an over-the-counter traded market, which means it's hidden. And so when you don't have a lot of price discovery, over time, things change underneath the surface that market participants aren't paying attention to. And they're not paying attention to it normally because those biases. Now take the incentive portion of this, and then that's this market on steroids. And what I mean by that is, as you know, show me somebody's incentives, and I'm going to show you the outcome of how that plays out, right? If somebody's incentivized to call bottoms, they're going to do their best to call bottoms. If they're incentivized to get out at tops, they're going to do their best to do that. But if they have no incentive, whether it's job security or whether it's financial security or financial incentives to do it, they're just going to go along and get along, right? You remember the old adage, nobody ever got fired for buying IBM? If you're a tech manager, buy IBM. Don't worry about it. If it doesn't work, oh, well. Well, here, if I'm paying the same as everyone else and it goes up, oh, well. And layer on top of that, they, being fuel buyers, are not paid to call bottoms. Why? Because the cost of the uranium is de minimis. And so the structure of the market is such where really bright people, nuclear engineers who operate these plants and buy the fuel, are not paid to call bottoms in uranium. They are paid to secure supply. Now, that means when they're staying out of the market, they just figure if it goes higher, that's the market telling me that we need to start paying up for it. So prices have gone from 17 in November of 2016 in the spot market up to 100 at one point, high 80s at another point. It sits in the high 80s today. But the contract price has gone from the high 20s up to around 90. But the market-related portion of it, where ceilings and floors exist, the collars, that's not reported by the price reporters, but is where 75% of uranium in the contract market trades today, give or take, has floors of mid-70s and ceilings of upwards of 160. Price has gone parabolic for those utilities that are out coming into the market. So what does that look like? last year, on roughly 200 million pounds of demand, if you look at the industry forecasters, they'll show you 180 or so. It's wrong. They're not including some. They're excluding certain things, by definition, not including others. But we use around a 200 million pound number on that, and they contracted at 116 million pounds to utilities. So above the mid 40s, but barely above the mid 40s. But let's go back the last couple of years and take a look at what that's looked like. In 2023, the utilities contracted at 164 million, 165 million pounds. So they were getting close to what was less than 200 million pounds, and prices were up. You were talking about contract pricing in the 50s and in the 50s range. Now all of a sudden in 2024, even though they're not financially incentivized, utilities didn't like the fact that pricing kept rising and rising and rising. If you talk to them, which we do since 2018, that's what gives us the conviction, by sitting there and talking to them and having these folks who are way smarter than we do tell us that our fourth grade math is wrong. Because you know what it tells me? They haven't done that fourth grade math. These are nuclear engineers and nuclear scientists who have no incentive to get it right, and that's their Achilles heel. Yet they choose to ignore the math. And so at the fourth grade math, so pricing only rises because demand exceeds supply. And so you can break it all down, but at the end of the day, prices go up because there is too much of something. So when something goes from the mid-20s in the contract market to ceilings of 160, there's a reason for that. And that is because the people selling it don't have enough of what you want. And so that's how pricing has been climbing. And so in 2024, the utilities said, you know what, we're not going to participate as much. And when you would talk to them, you go to conferences and you sit and have a beer with them, you grab them in the hallway, you talk to them, you have a meeting with them. What they will tell you is there's plenty of supply. We have no concern. And that's the head scratcher, Matty, because like I said,
your head in, wouldn't it?
IQ points at orders of magnitude greater than I can ever have. And yet I just sit there and say, you've got to be kidding me. Lay it out on spreadsheets. And I'm not a spreadsheet junkie, but I could value a company on a legal pad in 10 minutes. But we do the spreadsheets, and we have models that do everything. And we've been building supply demand models for a decade in this space. And that's the thing that doesn't make sense. So in the year that they went from contracting 165 million pounds to 116 million, or 124 million pounds, sorry, in 2024, it went down materially. Pricing went up well into the 20%. But you look at commodities. What commodity does demand fall off a cliff and pricing goes up? It doesn't, unless something is amiss. And so why? Because there wasn't even enough uranium for the people selling it for the reduced demand. Now, so that's 2024. Last year, right, there was 116 million pound contracted. Pricing went up low double digits again. So 2 years in a row, when you speak to the fuel buyers, some of the biggest in the world, they're angry and they're pissed off, and they believe that uranium is theirs, and that they'll determine it because they've determined it for so many years, and they are literally like deer in the headlights. And the odd thing is because they don't have that financial incentive. They're not going to get fired for what they pay. They'll fired if they get run out. So you asked me what the catalyst is. I don't know, but here's what I do know. There's 60 nuclear power plants, give or take, in the world that run these 430 plus reactors and 70 under construction. The top ones in the West, right? And let's see, here's a number: 70% of the power is 70% of uranium is produced in the East, and 70% of the power is in the West for nuclear power. But you're in a situation where these folks are running out of time, and at the higher level, the top fuel buyers in the world, they know what's going on. They're contracted out. They're not happy about it, but they're not contracted out through 2040. but many of them are contracted out through the early 2030s, which is yesterday in purchasing because it's a 2-year fuel cycle. You've got to prepare, you've got to do price discovery and contracting. But it's those reactors around the world, and there's several of them. It's those plants where there's one or two, and that fuel buyer is just paying attention on the periphery because he secured his, or she has secured their supply for 5, 7, 10 years. There's no price discovery. They'll go into the market, and if they do go to a conference, all the other fuel buyers are saying, there's plenty about it. Don't worry about it. I was at a conference in Charlotte, in Charleston, South Carolina, in October or November, sponsored by the Nuclear Energy Institute. And I sat down with one of the biggest fuel buyers in the world, very sharp guy. And he said, I know on paper there's not enough uranium. I get it. I'm not really worried about it. I said, I'm just curious why. I said, obviously you're not going to run out of fuel because you probably have fuel for the next handful of years. He's like, yeah. I said, so what's your concern? He said, why aren't you concerned? He's like, the uranium fairy always delivers. It always delivers. I said, oh, okay. Tell me you haven't done the math on the macro supply and demand without telling me you haven't. I'll take it back to at one of the largest conferences at the World Nuclear Association just a couple of months prior to that in London. And I'm sitting with another very, very, very large fuel buyer, one of the biggest in the world. And a few years ago, over time, you couldn't get a meeting with these people because they told us that we were stupid and dumb and didn't know what we were talking about. And then as time's gone on and we've hung around and they see we're not a fast money fund, this fund said to me, the fuel buyer said to me, look, I get it. I know maybe pricing goes up. I don't know. Maybe, and at this time, spot pricing was, I don't know, low 80s. He goes, maybe it goes to $100. He said, but once Nexgen comes on in 2030 and Denison's project comes on in 2030, it all goes away. There's no problem. I said, oh, come on, like you don't believe that, right? I know you don't, or you haven't looked at it. Because Nexgen coming on, and for those who don't know, it's the world's biggest uranium mine that's supposed to come online in 2030. We own some stock. Is it going to come on in 2030? I have no idea. Do mines come online and on time? Probably, usually not. I also know that a couple of things. Number one, that world's biggest uranium mine at the highest grade and so on and so forth that's coming online, they don't have to sell all their pounds at one time. So don't look at capacity, look at and it's very, very high grade, very, very low cost. They have a lot of flexibility and they're commercial. That's number one. And so, it's like, okay, number two is if they come online and if you do the math and if you do the demand math, you realize you still got a problem. And so, what I said to them is, I said, let's just take let's take everything at face value. This is the highest grade mine. It is going to come on time and so on and so forth in 2030. What if it was more strategic value to somebody that decided they wanted to own it? It's a public company. What if that happened? And it didn't come online because they didn't find value in bringing it online right away. It went into a pipeline. Maybe it's a multi-commodity company. Maybe it's who knows, make it up. I don't know. Maybe it's another uranium company that might decide they have mines running out in the mid-2030s and they want to bring it on and into their pipeline. I don't know. Maybe it's a major mining company. Maybe it's a major oil and gas company and then it doesn't fit into your plans. It fits into their plans. What's plan B? Deer in the headlights. And so those are the catalysts. Now, it's not going to be them. They'll figure out what to do for a few years to get what they need. But it's those small reactors that one or two, you talk to them, they have no idea what's going on. Not because they don't pay attention, because they're running a plant, they're busy, and they buy uranium every 5, 7, 10 years. Those are the catalysts. When they occur, I don't know. In the meantime, we just sit and be patient.
Isn't it funny the way you put it, and it makes a lot of sense now that the one thing that will drive the uranium price up is the fuel buyers, but they're waiting for the price to be driven up to make them buy it. So it's like fighting against itself. So yeah, it makes a lot of sense why it's done nothing, like hasn't really taken off now.
It's like they went into a boxing ring with a blindfold.
Yeah. No, it's like they're fighting themselves, like fighting in shadow boxing or something. It's funny about Nexgen. I was chatting to an Aussie guy actually, but he's got a lot of historical shaft sinking experience in the Athabasca Basin actually, and I was saying, Nexgen have got they got two shafts. There's I think one's 700 metres, one's 600 metres. How long does it take to sink a 700 metre shaft in the Athabasca Basin? He said, well, good going 3 metres a day, bad going 1 metre a day. So 1 to 2 years just to sink the shaft, but then he said, probably add another 18 months to 2 years for long lead items and freezing the ground. And then that's just to get the shafts down. So there's potentially 4 years. And then you got to develop the whole underground mine off that to then apparently hit essentially 30 million pounds in year one. So, and we're at 2026 now. So just there's some simple maths there that shows maybe 2033 would be optimistic, I would say.
Well, and and that project, other projects that people point to, and I know obviously people look at the NPV, and if it's not producing in next year, the NPV could be lower. What I think gets lost in that translation is the price element of that, because if these projects don't come online, the deficits are huge to begin with. And if any of these projects get delayed, the pricing goes much higher, which will dramatically impact the NPV.
Yeah.
So, it's a very interesting time. I've been investing, over 30 plus years, and I've just never seen complacency like this. But it is what it is, and I've learned not to over time, because I would say we started investing in uranium in 2018, and 2021, 2020, you'd say to yourself, like, are these people serious? Like, these fuel buyers, like, you got to be kidding me. And now I don't get worked up over it, because, it is what it is. Pricing keeps going higher. The spot price moves the equities too. So AI data centers and SMRs move the uranium equities. But also there are those times where spot pricing has a surge. And again, it's a small portion of it. And people sometimes will come in. I was just speaking at a conference a couple weeks ago, and talked about the role of the spot price, how it's a very small percentage. It's really just traders moving pounds back and forth. There's utilities that the only end customer really, with the aside of a fraction. In fact, the military buys, it's 99% utilities buy almost everything in the contract market. So what's in the spot market is just some offtake from some mines sloshing around amongst traders, whipping it back and forth, who don't have big balance sheets, and they go back and forth. Yet at the end of the presentation, I'm sitting there, we're having lunch, and people are asking me, what's going on with the spot price? And and the reason for it is because it's reported once per day at 2:45 p.m.
They've got access to it.
So they have access to it. The contract price, the term price, is reported once per month. So it's what people focus on.
Yeah. What do you think it says about the state of the market, or is it a bit of gamesmanship when you got Grant Isaac on the Cameco call, like effectively saying we're not expanding anything, we're not going into any longer term contracts at the moment because we just don't need to until the price goes up? Is that their thoughts, or they're like, just have a look over here while we're trying to get Nexgen a bit cheaper?
Yeah. So I hold them in very high regard. I hold Grant in very high regard. There's Cameco during the bottom did its job and put the industry on its shoulders with shutting down mines and doing stuff. And I get the criticism sometimes of it, and I don't talk about companies, but just talk in generalities. Oh, they don't have this massive exposure to spot pricing right away because they've sold out some of their contract book. And for some people who want that's fine. I get that. There are some people who need pure spot exposure. That's great. If you know the future and you just want all spot exposure, But when you're running a company and you're closing down mines and you're trying to figure out how it goes, you maybe you sell a little bit forward at a little bit lower pricing, but they have a lot in the ground that they could still sell. But I don't want to get into, I don't discuss the individual companies, but I think, remember who Grant is speaking to different constituents on those calls. Speaking to investors, and he's speaking to competitors, and they don't have competitors, but because they're such a behemoth, and the power of incumbency is immense. They, of course, they have competitors, but not at their scale. But they're talking to utilities, right? So you think about that fine line that he has to balance. And so I think what he's saying is we can bring it on, we could bring pounds on, but you got to send us the signal, Mr. Fuel Buyers. When you give us those signals, we'll do it. We're in no rush to do it. If you go to them and you talk to fuel buyers, Cameco's not selling them pounds right now. They're not selling pounds until the early 2030s. So, it's a seller's market. They're in control of it. Now, somebody could sit there from the outside and say, well, that could just be posturing. And a lot of people say that. If you're in the fabric of the market and you're talking to people on a regular basis, that's not posturing. They know their leverage they have. And they don't get that often, right? And if you, Grant often says you don't get a second chance to price new capacity. You don't. And so that's the leverage they have. If you want us to bring on new conversion capacity, new uranium mining capacity, let's just not talk price. Let's talk tenor, right? Because it could all sound great. We're partners. One of the things that I would say to Grant, and he's probably sick of hearing it from me, is stop referencing the utilities as your business partners on conference calls. In a nice way. There are partners, and Tim Gitzel will say there are partners, right? You consider a supplier, and I'm a little more cynical than that. Now I'm like, they're not partners. They don't care. The utilities could not
They didn't back then. They're the ones that put them in that spot. They could not care less if you went bankrupt. So now they're very political, right? They're elegant in how they speak. Grant's as eloquent as they come, and they're balancing relationships, and I get that. But the way they're expressing the leverage is by not signing contracts. And so that ultimately will accrue to them. The power of incumbency is real, right? When there's not a lot of people who do what you do, that's pretty real. So, you can argue valuations, you can argue anything on any company. I'm not talking about Cameco. But when you just when we're looking at any market and we're looking at, okay, who are the big players? Well, that's one of them. So you asked me, is he trying to talk it down, like to get a lower price? I think he's talking realities to the fuel buyers, is what he's doing. And he does also, and I see it. We own some smaller companies, smaller developers that rush out and sign contracts that they're stupid contracts. One of the things that we pride ourselves on, and we don't know a lot about anything and anything outside, if we know anything, it's probably the uranium, but we know a few things, right? We're certainly not the sharpest tools in the shed, or the brightest bulbs in the pack, but we can do this simple math, and we've been doing it for a while. We kind of understand the uranium market. And one of the things we've always noticed with a lot of these small developers, hey, stop making up stories about costs. Okay, they're higher than what you say they are. So in those glossy presentations, when you're out trying to raise money, the real costs in there, right? Because there's a structural deficit, and fuel buyers need to see what the real costs are going to be. Because then when you're out trying to tell them what the higher price that you need is going to be, it makes sense. Not when you show them that everyone. I have yet to meet a uranium producer that's not in the first quartile. Like, really, on the cost curve? How is that possible? So they all just, not all, but most of them, show lower costs, but also demand higher pricing because you can get it.
So when they sign dumb contracts, do dumb things, win dumb prizes. So when you sign lower than necessary prices, that as an investor pisses me off. And also you set a bad precedent, right? So if you've got the biggest guy in the world out there saying, we're not selling to you, we'll sell to you in 2035, and here's the price you're going to pay. And for somebody who needs, make it up, £1 million a year, well, then the utility says, you know what, let me go to this little developer that needs to put a win on the scoreboard. They need a W. So let me go to them, and I'll buy 100,000 pounds from them, and I'll get them to sell to me a little bit below what the even contract price is that's reported once per month. Why? Because I know that contract price, that the price reporters will look to the lowest price that they could find that month and then set the price based off that. So you've got the big fuel buyer goes to said junior developer for a rounding error contract, prices it a little below. The junior developer feels real good about themselves. And then, the old saying is, if you're looking around a table trying to figure out who the patsy is at the table and you haven't figured it out, it's probably you. Well, that's the junior developer, right? I get it. You need to put up a win, but you need to also understand the market you're in. You need to understand the supply demand, and not all, but I can't tell you how many, even on the exploration side, how many of the management teams don't have a good handle on the supply demand. Because if they did, they wouldn't give away the ranch. And so I think that's the other one who they're talking to. And if you listen to their conference call, listen to Alkin, for a decade, when they're talking about that, they know it makes their job harder. It makes investors' job harder when you have these one-off random companies signing prices that are not where the market is right now. And it's part of the fabric and knowing the market structure. Price reporter reports lowest price they can find, period. It's what they do. And so the utilities know that, and they play that little game with that. Now, if that developer never goes into production and they're not going to deliver, or it's going to be way late, that big utility doesn't care. They have 100 or 200,000 pounds that they can make up. They'll get it. It's in their inventory. They're not one of the tiny ones that are going to run out of fuel. They won't run out of fuel. They'll borrow. They'll do whatever. But that's the gamesmanship that takes place. So that's where I think Grant is talking to on the calls, that constituency. So he's serving a lot of different masters on those calls.
Oh, it's not who he's talking to on the call; it's who's listening to it afterwards, isn't it? Which is everyone. Mate, China, because if you talk about, correct me if I'm wrong, the most active country in uranium nuclear as we speak in terms of reactor build-outs and I would assume in securing future pounds. We just saw the Bannerman deal go through, which great deal for China, I assume. 60% of Vitango's going to them. Bannerman got slaughtered on it on the open. They obviously can't come to Australia to get uranium because Australia's just shit with uranium. They won't be getting it from North America. Are they going to be becoming even more active with these 10 reactors builds per year in securing U308? This is potentially just the start of it?
I think so. I think what you're seeing is that they need, 10 reactors a year. It's an immense build out in the 50s and 60s reactors that's going to go. You just keep going, and people will point to them and say, "Oh," and the numbers vary. Between 500 and 600 million pounds of inventory. Oh my gosh, look at that! They have forever inventory. Well, first of all, they want inventory that will go and last out for decades. But I think what's really important and that people are not realizing is that if they stopped buying uranium today and they weren't contracting, their inventories are basically down to very small levels over a very short period of time because of the amount that they're consuming and the amount they're doing. Now, if you're China and you're looking to go and try and find where that they can go find uranium, they really can't go buy a company in the West. Nobody's going to sell to them in the West. They really can't go do it in the so they can't do it in the Athabasca, right? They can't buy controlling interest. In the U.S., there's not that size, but they could, if they wanted to, they could do some. Be really tricky. Do it in Australia. So where are they going? They're going to Africa. And when they're going to Africa, they're going and finding some really interesting and good projects. And so that's where they're doing it. They're going to continue to do it. If you think about if you think about their plan, would like to be a third indigenously produced. Would be great, but they don't make enough to do it. So they're going to have to go elsewhere. And Namibia has been a big home for them with the mines that they own over there. So I think you're going to continue to see them try and do deals like the one, they have a deal with Paladin where they get a quarter of the offtake. This, you're going to get 60% of the offtake from the Bannerman deal. So it's a real issue. And those pounds, when they sign pounds, like they did there, those pounds are not now going to the West. You got to remember the pounds that they're also doing in Kazakhstan. They built a storage facility right on the Kazakh-China border. A lot of those pounds are going to be going, that the Kazakh pounds will be going there. So, I mean, I don't think that the West appreciates how much China is going to use. If you look about their requirements right now, it's 42 million pounds per year. By 2030, that's going to be 65 million pounds. By 2035, you're looking at 89 million pounds. By 2040, you're looking at 103 million pounds. So they're going to be doubling their requirements over the next 15 years. You're going to be going from China being as a percentage of the global requirements, going from 20% to 35% by 2040. So you're looking at some really material amount of demand that's going to be emanating from them. So, where are they going to come from? It's going to come from Kazakhstan, which is going to be, I think it's about on their JV basis, out of their 5 JVs, it's 10 or 11 million pounds a year. It's going to come from Rossing in Namibia, 4.5, 5 million pounds a year. It's going to come from Husab in Namibia, 11 million pounds a year. Langer Heinrich is in Namibia, is going to get them owned by Paladin, 1 million, 1.5 million pounds a year. Domestically, 5, 6 million pounds a year. But, right now, you're looking at over 30 million pounds a year, 40 million pounds. So they need to go on a buying spree. And, they're going to be competing for pounds that the West thinks are theirs. There are some development projects in Africa that are sitting ducks that the West thinks could be theirs. Well, they may not be. So, it's really tricky.
And it'll be so fun because they can obviously build the reactors the quickest. They're building the most reactors, and I assume the fuel demand is front end weighted because of the initial core load of all these, like you to triple the uranium per year per new reactor. It's going to be very, very high at the start for a long time.
Well, yes, it is. And you're right, Matty. And here's, like if you think about a number, China sourced offtake as a percentage of their annual requirements. They can source right now between their offtake agreements and their own mines, 3/4 of their annual requirements. By 2030, that's down to half. By 2035, that's down to 35%. Said differently, that's them going out in the world market competing with all these utilities. Yeah. So it's a very, very interesting scenario that I don't think the West appreciates at all. So
last bit, mate. So you can start your day, mate. I don't know if you're probably
you can go to bed, right?
Yeah, that too. Yeah. This probably annoys you talking about this mob and the function of it. SPUT, Sprott Physical Uranium Trust. They've bought, and I've asked this question once already this week. They've bought £5 million already this year of their £9 million quota, and they'll probably, I assume, buy the next 4 very quickly. And look, whether you like it or not, Mike, it does have an influence on the market at the moment, the way it moves the spot price, which moves the equities, like discounting the underlying structural supply side of things. What do you think they're going to do if they buy their £9 million? Are they going to get funky and, do some contracts or something that don't necessarily mean pounds this year? Then do you think they'll sit on their hands? Like, what is your take on this vehicle that is?
Yeah, sure. So I think a couple of things. Well, what they'll do, I don't know. If they bought it sooner rather than later. If we go back and look at the last couple of years, there was many months before they issued any equity to go buy any uranium, right? We can look back and say there were several months. It was trading at a discount almost like regularly. And so when we look at that, you can say, okay, well, it's trading at a discount regularly, yet again, I know what moves the stocks, contracting kept going up, pricing kept going higher before they were in the market at all. It was going up and it was going up and it was going up. SPUT leads for a long time, SPUT leads the contract market. SPUT has done its job. Back in 21, 22, they cleared out a lot of pounds. Now they have pounds and they move it up. And so you have traders, they were also, SPUT was going for their new shelf prospectus. And there was a period of time where they were a couple of week window where they were not in the market. Traders were, again, remember I said earlier, traders don't have big balance sheets. They don't have big inventory sitting around. So they were out front running them. They took the price from 85, 87 up to 100, 101. Now SPUT all of a sudden gets the cat there. Now they can go out and start buying it because their shelf prospectus was approved for the next 25 months. And now the traders are selling it to them right away. And SPUT stepping back because it matters. They care what they pay for it. So what happens? I don't know. Can SPUT go back to their regulator and ask for change? I suppose they could. Can it happen? Don't know. But we're at a point where I think the utilities, and again, just come from knowing them, speaking to them, the spot price is going to drive. You're at a point where you can't stay out of the contract market. They have to come into it. And I think as contract pricing continues to climb, at some point that will drag spot with it, because as more utilities, and you're seeing RFPs come into the market, and remember, the price reporters will put out and say RFP, RFP will come into the market, and so that means a utility is looking at a request for proposal. Oh, here it comes. That 90% of what gets signed is never talked about. It's bilaterally negotiated, right? So again, just like the spot price is a fraction of the market, so too are RFPs in the market. Yet the price reporters and everyone hinges on with bated breath, an RFPs in the market. And silently, you've got others signing these deals. I just think the market is so tight that those prices will continue to move higher with the floors and ceilings. And if SPUT doesn't go, if they went and did it sooner rather than later, so be it. Financial buyers are in the market now. You're seeing other financial players. You're seeing other hedge funds coming into the space that are buying physical uranium. So it is not just SPUT. So it kind of is what it is. I've long not focused on. You can't worry about what they're going to do because the fundamentals of supply and demand are overwhelming in the contract market, and SPUT doesn't participate there. I can't imagine a scenario where they're contracting. That's not what they're designed to do. So, it does come up. I get it. You just got to ride through. Nobody has to do anything, but we choose to ride through that volatility of that.
Well, it's going to what they got at the moment's 4 to 5 months worth of annual demand anyway. So it's like it's classed as a big number, but it's not that big for what the world needs going forward.
We've heard people say, "Oh, well, Sprot's going to have to liquidate." No, they're not. I don't know anything, but well, Sprott. What if they decide to sell it? Okay, 70 some odd million pounds. I can't imagine a scenario. Never say never, but where they would. But I don't think that. I don't worry about that. I shouldn't say that. I always worry about everything, but that's not what the trust is designed to do. I don't think they're going to loan it. I don't think they're going to sell it. If I was 100% wrong on that, okay, so now you've got 70 some odd million pounds into the market out of a 200 million pound demand. What do you got next? Do you know what I mean?
Yeah.
That doesn't solve it. That doesn't solve problems. So
that randomly, if that happens, like if someone put a big offer in to buy all of SPUT and they had their 66% vote in favour for it, it could be a stupid price, and that could be the new uranium price. That could be the catalyst.
Absolutely, Matty. Somebody could come along and say, "Hey, we're going to bid it at a crazy price because they wanted a consortium, make it up," right? Who knows?
Yeah.
And then that sets, and then the question would be, well, why did somebody pay that? What did they see? Why were they willing to pay such a premium? Well, there's your answer.
Yeah.
Right?
Yeah. Oh, mate, great note to finish it on, mate. Thank you so much, and can't thank you enough for your valuable time, as always, mate. And I reckon you still enjoy yourself doing these.
I do. I really do. It's it drives me nuts some days. The other days, But the more I'm around them, the less I think about them, the fuel buyers.
Oh, right. Very good, mate. Mate, you have a lovely day over in New York, and hope the weather treats you well.
Dude, thanks, man. Enjoy your evening.
Will do, mate. Will do.